All right, so what I want to do is go through each one of my strategies and see how they're performing. I think this will give you a better idea of what I do and how each strategy is doing. I feel like I have a lot of irons in the fire, so let's take some time, break it down, and go through it together. All right, before we take a deep dive into the strategy, let's see how the markets did today. Right here on the hourly chart on the SPY, we see that overall, long term here on the hourly chart, it looks like it's trading in a channel. I believe the market is calmly, patiently waiting for what the Fed is going to say tomorrow on their plans for interest rates. So we can see it's trading a nice pattern here, and today it actually did pretty well. All right, so most of my positions are in futures. Let's start off with the copper futures. So you can see right now I've got a strangle on. It's at 384 for the put and a 435 for the call. And what I'm doing is I'm selling a put on the bottom here, and then I'm selling a call on the top, and then I'm hoping that the price stays in between those. And then if it goes outside of that, I have to make adjustments to try to stay profitable, break even. I haven't had to do that yet. So right now you can see we're right in the middle. The current price here, this red flag, is right in the middle between the two. So that's the best place it can be. And you can see I'm in the green in the theoretical price. And also, I expect to have half of the expiration price up here. So that's $1,725. So whenever I cash out, I should have about half of that, best case scenario. What's working really well for me with copper, and something that I've learned with doing strangles, is that whenever the implied volatility goes down, your option price goes down and your profits go up. So let's take a look at my profits on the call and the put. You'll find that they're both green. So you can see right here, I'm up $268 on my put, and I'm up $281 on my call. Normally you would see a pull and tug, right? If all else was equal with implied volatility, if you gained $1 on your put, then you'd lose $1 on your call because you're going down in price, up in price. But the variables behind this is the theta decay and the implied volatility contracting. And so that's what's happened here with copper, is the implied volatility has contracted since I bought it, and then the prices have gone up. I also am able to collect some decent theta as well. So we can see right here with copper, it's 44.7 with theta. I've also got positions in the iShares Trust Treasury floating rate. This is T-flow. What I use this for is mainly just any extra cash that I have. Because I'm using futures, it is leveraged. Any extra cash that I've got in my account, I'll be able to collect a little bit of interest there. It pays a dividend, and then whenever it pays a dividend, the price goes down. It's a very steady asset to put your money in. And so if I've just got cash sitting in my account just for the leverage in my futures, I might as well put it in something that's going to make some money, even if it is just a little bit. So right now I've got about 50 shares in T-flow. So this futures contract here is the E-mini of the Russell 2000 index. Basically, this is a futures version of the Russell 2000 index. I'm selling a put at 1950, and then I bought one for coverage at 1925. I'm only responsible for what's in between the strike prices there. Right now, the price has gone down since I opened the position, but it's not too far from where it was, and it's above my puts. So that's okay, just holding on to it, waiting for the price to go up. We'll see what happens with that. But so far, not too much activity there. I think I'm down overall. That's just because the price has dropped a little bit since I've opened the position. At expiration, I would be fine because it's above my puts right now. Tesla right now has been dogging on me. I am in the money on the two puts that I'm selling, and I'm covering myself around 155 and 145. So right now, I'm just waiting on the price to go back up. I'm close to being out of the money and back into profit. What I've been doing is rolling it later into time. So I had positions that were close to like 30 days, 22 days. So I decided to push it back to 45 days, collect that premium, and I'm just waiting for that price to go back up, and I'm lowering my break-even point. So Tesla overall, let's take a look at the stock price and the hourly chart. We can see that whenever it opened, it sold off, and then it had a nice recovery here following these trend lines. Also, I made a video recently about what I think about Tesla, the direction that it's heading, and what Kathy Wood predicted about it. So my next position here is natural gas. We can see that I've got a strangle here. I've got a -1 put at around $1.45. Then I've got a -1 call at around $2.15. And then so I'm hoping that the price will stay in between here. So right now, this trade has about 37 days till expiration. I'm hoping that it will close with a 50% profit before 21 days to expiration. So far, it's been really well. The price has gone up a little bit here since I've opened the position. I would say it was around $1.73 whenever I opened the position. So it's gone up a little bit, but it's not bad. It's within the range. As long as it stays between my put and my call, I'm good to go. So, but the natural gas futures here have been pretty steady for me. Nothing too much to be worried about natural gas here right now. So right now I've got a strangle on the micro E-mini S&P 500. It's got 31 days till expiration. And like I said, I'm hoping that it will stay in between this price and I can close the position at 50% profit before 21 days to expiration. If I don't close the position by 21 days, then I'll end up rolling it to the next expiration. As you can see, the price has moved up toward my call. I could make an adjustment on my put here and collect premium, but I really don't want to mess with it too much. I'm more of a passive person. I want to see it play out. I'll make a move if I have to, but I think the price is going to stay within that range. So we have the micro E-mini S&P 500 futures. Now this is the E-mini S&P 500 futures. It's all based on the S&P 500. I'm using the E-mini S&P 500 right now for put spreads, and I'm doing the 30-20-10 strategy. So right now you see I've got a lot of positions on, and they are a lot of small positions. What I'm doing is every day I'm going to the 30-day expiration, hitting a 20 delta put and doing a $10 wide spread. So I'm buying a put $10 up from that position, and I'm doing that every day. So here it looks like a mess. Let's pull up the option chain and you can get a better view. So you can see here I've got at 30 days up position, 29, 28, 27, 24, 23 days to expiration. All of those are a 20 delta put spread, $10 wide. Eventually it's going to go all the way down to expiration. What I'm going to do is collect that premium, close out the position, bring it back up to 30 days, and then keep that process rolling every day. So right now you can see my 28-day position. And at the time it was a 20 delta whenever I put this position on. Now it's at 14. So since the price has gone up further away, it's great for my position. So then what I'm doing is waiting for this position to go all the way down to 0 days to expiration. I can either let it expire, close the position, and then bring it back up to 30 days. And then once I collect enough money to be able to open up more contracts, I'll do multiple contracts at 30 days every day. So that's my plan on the 30-20-10 strategy. So far it's been working. I haven't been able to see the results yet. I think it is an interesting thing to watch, and it does keep you busy because you're placing a trade every day. And it's pretty mechanical. There's not much thought to it. 30-20-10, 30 days to expiration, 20 delta, and $10 wide spread, and it's a put. So we can see here so far with the E-mini and the 30-20-10 strategy, I'm up $123.75. That's not a realized profit, but that's where I'm at so far. So my last three positions right now are bonds, and they're different year bonds. I'm not too familiar with these. I did definitely want to diversify my portfolio. I'm in different commodities, and I'm in these bonds, and I'm looking at how they relate with my positions in stock. Looking at the overall market, looking at the S&P 500, looking at my futures, E-mini and micro, and looking at how they play against these commodities, and they all move in their different ways. Here's the 2-year treasury note. At first I had a put spread on, and I decided to sell back the put that I bought to cover myself, and then I sold a call and turned it into a strangle. So it does look a little bit different. You can see my theoretical price curve here looks a little bit different. It's a little offset from my strategy, but I was learning about strangles and I wanted to go ahead and apply it to one of these treasury notes. So I decided to do that. So far it's working well. The price of this 2-year note went down since I opened the position, and now it's kind of coming back up. So I also have another strangle here on the 5-year treasury note, selling a put, selling a call here. The price is still in between, and I'm just hoping to get out with a 50% profit before 21 days. Again, if I see 21 days, then it's going to go back up to around 45. The trick with these though is that I don't have a whole lot of room. So there's only a few of these positions that you can roll. So if I get to 21 days, I only have one roll at a time that I can do. So I can't really, as far as movements in time, I don't have a whole lot. But thankfully, the volatility of these positions are not very high. So it's pretty steady, not too much action going on. So we've got 38 days on the 30-year treasury. I've got a put spread here at 115, covering myself at 114. And I had these positions open, very new, just trying it out to see what it's like. So I kept the spreads pretty tight just to be safe, get my feet wet, just to kind of test it out. So here in curve mode, you can see my spread here and then where the price currently is. You can see I'm down on the position, not much. Actually, and overall, the bond prices have gone up. And I think that has a little bit to do with the Fed meeting coming up tomorrow, talking about interest rates. We can get a better look here on the daily chart here with the 30-year. It was going down for a good while. It bases out here. Now it's starting to turn. Like I said, I really like doing the strangles. I may be doing really wide iron condors just because I see opportunities in other underlyings. The problem is the capital requirement is pretty big for my small account. I'm trading in about a $17,000 account right now, so it's hard to be able to do some bigger moves. And my goal is to try to trade small and trade often. If I'm going to do some other underlyings, like crude oil, for example, it's going to take $7,000 to do a strangle. But if I do a wide iron condor, I can limit my capital and still be able to participate. That's something that I might be playing with, but right now I really like the strangle idea. I benefit from the price if it stays in a certain range, so I have control of the range size, and I collect it on the put and the call, so I'm getting double the premium that I would if I was just selling a put. And doing a wide put spread puts me at risk. That's what has me in Tesla right now. I was doing a wide spread puts in Tesla. The price goes down into my put that I'm selling, and I'm in between the spread. The price is in between the spread, so now I'm stuck. And I think if I had a strangle, I would be in a better position. I'd be able to adjust better. So I really like the idea of using strangles. That may be something that I stick with. And also that I'm finding interesting is the 30-20-10 rule. And I'm doing that on the E-mini S&P 500 just because it's a lower capital requirement. I'd really like to be doing it on the SPX because the SPX options are cash settled. Collect your cash and then you repeat the process. With the futures, it isn't cash settled, so you have to be careful. If it goes against your position, you're going to have to roll it and not let it settle. Many of the E-mini S&P 500 futures are European style settlements. That means the buyer of the option has the right to execute the option after expiration. So the European style options are a bit tricky. You don't want to get caught up in the settlement process with that if you're not familiar with it. If you were going to do it on the SPX, it would cost around $18,000. I don't even have that in my account. So for me to even participate, I have to use futures. I want to keep you updated on the moves that I'm making and how my portfolio is doing overall as often as I can, to keep you informed, to keep you updated on the things that I've learned. So if you're interested in following me on my journey to a 50% return by the end of the year, and learning and picking up on stuff that I learn with options and different things like that, hit the subscribe button. And if this video was a help to you, hit the like button. We'll see you on the next video.